Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, April 8th, 2010. Let's start with a look at the European session, where we had financial markets continuing to demand a higher premium to take on Greek debt, which had caused a bit of a sell-off in Greek equities as well as a slide in the euro. The yield on Greek 10-year bonds rose as high as 7.5%, with the comparable German benchmark fetching a 3.09% yield. The yield spread between the two rose to as much as 443 basis points, the highest since the introduction of the euro. That spread had averaged about 65 basis points in the 5 years through November before concerns deepened that the country's deficit would swell. Also, credit default swaps linked to Greek sovereign debt climbed 53 basis points to a record 468.5 today. With the nosedive in the Greek equities and a rise in the bond yields, there was increased speculation that Greece will probably be forced to request a financial rescue after European Union aid pledge failed to stop Greek borrowing costs from surging. Now, the news did brighten up just a little bit for Greece as we entered the New York session, and that helped to buoy the euro, which had been sliding in the European session. First, we had the ECB President Trichet said that the debt default was not an issue for Greece. There was also news that the Greek first quarter 2010 budget, the budget deficit contracted 40% from deficit a year earlier. The deficit reduction figures today could give some validity to the measures taken by the government and could give investors some confidence going forward. The 40% decline, was achieved even before the latest additional government measures, cutting expenditures and increasing tax revenue, had fully taken effect, said a statement from Athens-based ministry. Also, Greek government spokesman says Greece does not need to activate the EU IMF debt rescue mechanism at this time. Before we move on to the euro-dollar pair in the currency markets, we did have the ECB deciding on interest rates today, where they kept rates at their record low of 1%. President Trichet already announced changes to ECB collateral rules in order to help Greece as it struggles to finance its debt. However, the Greek fiscal crisis has complicated the ECB's efforts to withdraw emergency stimulus measures. The indirect impact from the Greek case is that we may see more fiscal tightening from several Eurozone members earlier than the ECB thought, which has a deflationary impact and could slow down the recovery. The ECB predicts that Euro region economy will expand 0.8% this year after contracting 4.1% in 2009. There were some signs that growth is accelerating after ground to a halt in the first quarter, but we still have unemployment at an 11-year high. In data from the Eurozone, we saw that the German industrial production posted a flat reading in February after increasing just 0.1% in January. That was revised downward from an initial estimate of 0.6%. So that shows that industrial production in Europe's biggest economy has stagnated to start the first quarter. Also, in the Eurozone, retail sales for the month of February were down 0.6%, a reading that was much worse than forecast and is the weakest reading in 13 months. Here we bring up the euro-dollar pair, and we see that in overnight trading, we had a further slide in the euro as we broke below yesterday's low around 1.3330, and we reached today's low at 1.3280. That was slightly above the low we had seen in March 26th, just as the EU had agreed to the deal with IMF in order to create some kind of backstop measure for Greece. However, as I mentioned, we did have a bit of a turnaround in New York trading, and the euro managed to rally and test the 1.3365 area, which was our support from Tuesday's session, and now it looks to have changed to its role as resistance. That also was the 50 period moving average, that resistance, and if we plot a Fibonacci retracement, we see that today's high was also a 23.6% retracement. So there was some pause during New York trading of the euro sell-off, but we'll see if we garner any move above this level, or if it's just going to be another place for euro shorts to reload and further sell the euro. We had a similar dynamic in the euro-yen pair as we broke below the 125 level in yesterday's trading, hitting a low at 123.40 today. But as we entered New York session, we rallied, moving pretty much back to where we had started the day at around 124.80. If we zoom out this pair, we see that we had a strong rally in the euro yen starting on March 25th when we had reached our EU IMF deal for Greece. And if we plot a FIBO retracement, we see that we dipped below the 61.8% in today's trading. So again, we'll see if investors will reload and continue to sell the euro, or if perhaps this bounce will indicate some bullish pressure for the euro. Moving to our next main topic, the Bank of England also held its interest rate decision, where it kept its benchmark interest rate unchanged at a record low of 0.5% and held its bond purchase plan at £200 billion. We've had some recent data show that a strong recovery in manufacturing during February allayed fears of a double-dip recession. With Britain facing a deficit on par with Greece's, the absence of a clear roadmap could increase the threat of a downgrade to the nation's top credit rating, and as we have a looming general election, it may play a role in how the pound fares going forward. With the recovery unfolding gradually, there seems little need for additional quantitative easing, but it remains too early to start tightening, so the current super easy stance of policy is therefore still appropriate. Also, the Bank of England saw the interest rate of inflation fall to a 3% annual rate in February from 3.5% annual rate in January, so that helped to soothe some concerns about price pressures. In that UK industrial production data, we saw a rather strong bounce back in February after cold weather and the withdrawal of government stimulus hit output in January. Production surged by 1%, well above the 0.5% forecast by economists, and more than offsetting the 0.5% decrease we saw in January. Manufacturing output recovered even more rapidly, rising 1.3% in the month compared with the 0.6% forecast. The pickup was broadly spread across manufacturing subsectors, so this is a rather positive report that could fuel some hopes that the recovery is gathering pace. In a look at the pound-dollar pair, the price action we saw today looked very similar to what we had seen both on Tuesday's and Wednesday's session. We had a sell-off during the European session, reaching around the 1.5150, but as New York traders came in, they bought the pound and gave support at this level. So 3 times we've tested this support, and 3 times we've bounced upward. So we do seem to be in a bit of sideways consolidation, trading within about a 140 pip range, following our rally in the pair from March 26th to April 2nd, and if we see a breakout of this 1.53 resistance level, it could mean further pound gains. So is this a rally followed by consolidation and then an extension of this rally, or are we seeing the 1.53 level setting up as an important resistance? So right now we're in this sideways trading pattern, but we'll have to see whether if we have a breakout of 1.53 or 1.5140 to see which way the markets want to push the pound-dollar pair. Turning to the U.S., the number of people applying for unemployment benefits rose by 18,000 to a seasonally adjusted 460,000 in the week ending April 3rd, which was an unexpected result as the forecast had claims dropping to 433,000. Continuing claims, meanwhile, for the week ending March 27th fell to 4.55 million. In a separate report, we saw that U.S. retailers' March sales exceeded already heightened expectations and rose to a record high, another sign that the U.S. shoppers are back spending beyond what they need. Total March sales rose 9.1%, a record high, with 92% of reported numbers topping Wall Street estimates. The news helped stocks in the U.S. to rally from a weak open, and we see that in the dollar-yen pair, that helped the dollar to pair its overnight losses to the yen. We tested the 92.80 level, which was our resistance back on March 25th, and now we're retesting that old resistance now as support. So a classic switch of roles for this price level. In a final pair for today, we're looking at the US dollar Canadian dollar pair, and in today's trading we saw the pair test this 1.01 level as resistance, and after that slid rather sharply back down to its 50 period moving average. Yesterday we had mentioned that the 1.01 level seemed like a logical place for a pullback as it coincided with our 38.2% retracement of this down move starting at 1.03 with our support at 0.9976. Tomorrow Canada does release its employment data, so that could be a market event risk for tomorrow's trading. We have a pretty light docket to finish off this trading week. Tonight, Australia posts measure of construction activity. Overnight, UK posts its producer prices. And tomorrow, we get the employment change from Canada, as well as a measure of US wholesale inventories. And that will conclude our broadcast for today. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching and wish you good trading.